Hi everyone, Happy New Year. So January 15th, 2026, new year, new plan. Looks like markets are continuing the same story that we had in the end of the last year, especially in precious metals. A couple of days ago, I tweeted on Twitter, I wonder what the price of silver will be when we do the show. So the price is $92, crazy levels. We had interesting events when it comes to Trump and the Fed. We had this unexpected video from Powell, so I'm sure we have a lot to talk about. So yeah, hi Raphael, hi Ted. So Ted, let's start the view. So what you see in this new year, and were you surprised when you saw this Powell video?
Yeah, I was totally surprised. But yeah, Happy New Year. Good to see you guys again. Um, I mean, it's not, in a way, it wasn't a surprise because certainly there's been a lot of noise. What was more of a surprise is that Trump didn't say anything throughout the whole weekend, and then denied actually knowing anything about it. So anyhow, let me dig into the meat of the presentation here for Market Talk number 66. What I'd like to talk about today is touch on some macro indicators, briefly talk about some 2026 themes, touch on policy and also positions and trades. I'll spend most of the time there. But we're still in Goldilocks, and I've got a new dashboard that I put together that basically breaks growth indicators out into leading indicators and lagging indicators. And what you see here is with initial claims and high yield credit spreads all signaling sort of a healthy economy. That's offset a little bit by the JOLTS data. JOLTS openings last week for the month of November actually declined. So that's given me a little bit of a yellow kind of concern area. Also, SLOOS, which is a senior loan officers survey, it's actually 6.5%, shows some slight tightening. And so 9.5%, which was the October number, is actually, that was more tight. So we're getting some level of loosening here. And then, of course, last week we got both ISM manufacturing, which was weak, so still recessionary. ISM manufacturing accounts for about 10% of the US economy, so it doesn't weigh in all that much, but it is used as a leading indicator of sort of economic health. And then we had ISM new orders, which came in accelerated to 57.9. So a very strong month. So it looks to me like we've got some growth accelerating in terms of some of the leading indicators here. Payroll growth, we've talked about. Payroll has been, the unemployment rate and payroll has been sort of a soft spot for the US economy, perhaps a jobless recovery at this point in time, with what we're seeing is a lot of productivity gains. And so productivity came out at 4.9%, which is huge. It's just a big jump up in terms of overall productivity. And then retail sales were reasonable. GDP now, which is the indicator I share a lot, actually printed 5.3, and we got a huge surprise in terms of GDP for the third quarter, which came in at 4.3% when they released that last week. So generally, sort of a positive growth scenario. When we look at inflation, kind of similar setup. We've got 5-year break-even inflation as a forward indicator. And you can see it's been pretty steady between 2.37%, dipping down to 2.25, and then as of today was at 2.36%. So it's elevated relative to Fed target. So, it's not saying all clear in terms of Fed policy, but it's at least, sort of trending in the right direction. And then 5-year forward inflation at 2.2%. Little change since the end of December. Also showing, that we're above target, but not bad. Now, I had to change this today because crude was actually making a big move, and then of course we saw crude sell off 4% today. I put this together around 1 o'clock, so it was trading at 59.21 on WTI. It is still very low, relatively speaking, down. So we don't really have any sort of an inflation threat creating any sort of inflation threat at this point in time. We do have CPI sort of steady at 2.7, core CPI at 2.6. Shelter inflation surprisingly ticked up. They were talking about, shelter inflation being something that's going to provide a ongoing decline in the CPI number, but it ticked up to 3.2%. That said, truflation has been printing from 2.3 at the end of October all the way down to 1.72% today. So that's truflation for whatever it's worth. A lot of people discount it, but it does take in daily price information, is showing a real positive in terms of inflation. Owners occupied rent, 3.2%. And then, of course, we don't have PCE and won't have core PCE, which is the Fed's preferred measure, until the latter part of the month. Basically, we've got a benign environment with relatively some growth happening, some surprising growth, some built on some productivity, with a relatively tame inflation rate, despite tariffs. So when I was looking at themes for this year, and you can see this on my Twitter page, I left a full sort of did a write out. We've got this sort of AI productivity. Last year we had a lot of AI talk. I think we're actually starting to get a lot of productivity out of that, and that could continue to manifest. Inflation's coming down. The Fed is not expected to cut more than 2 times this year, but I think they probably will, particularly if unemployment continues to rise. And then contrast that with what's going on with fiscal policy, which OB3 is the One Big Beautiful Bill Act, and it's basically administration's attempt to run it hot. And I'm going to touch on these 3-4 areas today: inflation, OB3, midterms, and affordability crisis, and how that relates to overall energy policy. Some of these others I'm not going to touch on today. I expected we might have an IEEPA tariff decision, which is the Emergency Powers Act that Trump has leveled all of these tariff policies on, but we have not had a decision for the past 2 weeks. That is expected soon, so that may be cause for some changes in the market. In terms of monetary and fiscal policy, we had a Federal Reserve meeting on the 10th of December, and even though they said they were in the October meeting, they were far from having a decision to lower rates. They did lower rates another 25 basis points. So since the cutting cycle began, despite a pause last year, they've cut rates by 175 basis points since the peak. And Powell said, with downside risk to employment having risen in recent months, the balance of risk has shifted. Our policy framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 0.25 percentage point. And that was because of the sort of softness that we were seeing in the employment numbers. Contrast that with what's going on in I call it T2, Trump 2.0. T2 world is all, and what's a lot of the talk here in the States has been all about affordability. The Democrats have finally come up with something that is resonating with the population. And so you've seen over the past month, let's say, some real steps by the administration to communicate a more affordable situation. And I think, you need to follow this money as these policies start to get implemented. So one is the One Big Beautiful Bill Act does lower taxes, particularly for hourly wage earners. Those that generate tips are excluded from tax. So there will be, and that's retroactive 2025. So they are talking about a lot of potential money coming into the market. And then we saw last Friday a real attack on the cost of money. The attack on the cost of money was this call by T2 to limit credit card companies to 10% maximum interest rate charge for the next year, which, in our country, they charge 30% if you're running a credit card bill. And so that was a real kind of shot across the bow for financial institutions. And then, of course, attacking the Fed, we referenced that at the beginning of the meeting with this lawsuit, or this actually it's just a subpoena. There's nothing filed yet, but it's a subpoena to testify. So a real all-out assault on the Fed, and really trying to get the cost of money down. That also relates to home ownership, which we've got a real affordability issue here with home ownership. He basically is pushing, last week pushed for lower rates by having Fannie Mae and Freddie Mac buy 10-year notes. They supposedly have $200 billion on their balance sheet, and he's encouraging them to buy 10-year notes, which with the Federal Reserve basically buying short notes, there's no one really to buy the longer term duration. So this could be a stimulus for lower mortgage rates. And we actually saw some movement in TLT and IEF last week. And then, of course, restricting corporate ownership, the big one being Blackstone Group owns thousands and thousands of homes, and they're calling for eliminating that. On the energy front, we saw a couple of weeks ago, and I got caught up in this, securing Venezuela oil fields to reduce costs. They're encouraging Iranian resistance. There's a barrel of oil at the end of this Iranian thing, and so be sure that that's part of the overall plan to reduce the cost of energy and keep inflation rates down. And then lastly, healthcare. There's been a lot of pressure on pharmaceutical companies and new rates released to lower the cost of drugs here. From a positions and trades point of view, what does this all mean? Talking about just to recap quickly, the dynamic positioning portfolio that I speak about mostly here is long only macro ETFs. We're looking at bonds, equities, commodities, alternatives, and FX as part of the overall platform, and then volatility adjusted position sizes and adjusted on a weekly basis. And then I use primarily trend. It's a trend following strategy, but it has a mean reversion overlay. So that mean reversion overlay has me really buying deeply oversold assets, and we'll take a look at a couple of those that allowed us to get into some moves early on. And then, of course, I've got stops at 2.5 times average true range and a 4-day rule in terms of when stops are hit. In terms of looking at how the markets are performing this year, I've kind of highlighted this is sort of the core asset groups that I choose from. And so this is as of yesterday's close. You can see SPY with plus 1.25, tech really behind the 8 ball at only 85 basis points, and Qs for the start of the year outperformed small caps, IWM plus 6.92%, another 1% today. So, small caps off to a ripping start. EFO, which is developed markets, 3.4%. And then where we have some real outperformance is with EEM, and gold, of course, continues. Silver, I won't even talk about because everybody does, plus 31.2% in the first 14 days of the month. Just absurd. Dollar's up. That's if you recall last time, I was short dollar, long FX. I'm now long dollar, not short FX. And then, of course, commodities. We've seen commodities start to take off, 4.75% in the PDBC composite fund. And we've seen FBTC, which is Bitcoin proxy, also start to take off. So I'll hit on some of those things as well. From a positioning point of view, as I mentioned, I am long US dollar, not a big position, but a position that was started very recently, first of the month. Long commodities through a number of different ETFs. Long resource stocks worked really well right out of the gate. Overweight international equities, and then overweight corporates. And I'm not going to talk about bonds at all, but I'm going to just mention TLT, which gave us a positive sign last week. In terms of trades themselves, let me start out with the dollar. And so we had this sell-off here in the November timeframe. I had been long dollar at that point in time. I got out, and then I got long other FX pairs. I was long FXE, FXF, FXY. And then I'm basically out of those positions at this point in time, the only one being FXA, which is Australia, that I'm still in. So I got a buy signal here at the end of December on the weekly chart. And you can see here the dollar. This is actually this is actually the dollar, where the dollar opened at the first of the year. This line is just sort of where are we in relation to the open for the year. And you can see the dollar has been pretty much in a straight line up. Not a huge amount, I mean, it's FX, but it's up. And the way that we've been playing that is with UUP. You can see here where I was long, I got stopped out, and then I got that buy signal again. So I'm back into the US dollar, I'm long. We'll see if this continues or not. It's kind of looks to me like it's a lot of chopping around, but nevertheless, signal said get long, so I'm long. FXF, I reviewed this last time when we talked. I got long here on December 1st, got a nice entry point, was able to sell some, was just holding, and then I got stopped out last week. Stop hit on the 8th and was out by the end of the week. FXF, which is the Swissy, has not been performing. FXA, however, I'm long FXA, which is the Aussie. I got long that on December 1st as well. Got a good pop, sold some, again, same time frame. I'm still holding that position. And so actually got a nice kind of pull back to the mean and a nice little start maybe to a new run today. We'll see. FXY, I bought this what I thought to be at a low back on December 10th. I'm out of FXY. We'll see if there's any intervention on the yen side or not, but it does not appear like at this point in time that they're going to be able to do much about the yen, or I don't know if there's political willingness to do anything, but right now they're just letting the yen deteriorate, which has been good for everybody's long Japan trade. All right, commodities. So this is PDBC. And I actually referenced this when we met a month ago. And when we met a month ago, it was on the 11th of November, 11th of October. I'm sorry, 11th of December. It looked like this thing wanted to break out. I think this is right in this time frame. Didn't break out, pulled back again. And now finally, we've got this sort of multi-year base in PDBC as a broad commodity exposure, trading higher. Of course, it got hurt today along with oil, which seems to have a geopolitical component associated with it with Iran. But it's this is something the last 5 years seasonally this instrument, a broad-based commodities fund, has been up in the month of January. So in terms of how I've been playing it, I was long on December. I got stopped out of a portion of my position. I added back to the position at the end of December, actually took a pretty good long here and was able to sell some on the 12th and sold some more on the 14th. I still have a good sized position. When I sell, on a pop, I'll take 10% of the position off. So theoretically, I have an infinite position because if I've always taken 10% off, I'm never running out. But clearly, the position was smaller than it was. But this thing just ran again, and my system says sell these big runs, and you'll see a lot of that to start the year. GNR, we talked about that last time too. That's a global natural resources fund. We got long here back on the 10th of December. Sold a little bit on this pop on the 9th, and then sold some again yesterday on the 14th. So it's been a great trade. It's a good solid position. It's a runner, so it stays open. DBB, this I've been carrying since the end of June and been trading around it. I've most recently added on the 12th of December and have sold 10% here, 10% here, 10% here, 10% here. Just keeps ripping higher. This is like copper, aluminum, zinc. All the base metals are wrapped up in this fund. And again, along with silver and gold have just been, and platinum have been rippers. DBA, I've been watching this for a long time. I got long this on the 9th. I was patient. It gave me a signal a couple of weeks ago. I waited. I bought some more. And then yesterday, it looked like it might be breaking down, but today I got a nice, further little signal. So I added a little. So this is a brand new position for me, opened up on the 9th. It's heavily weighted in cocoa. It's got wheat. It's got all kinds of agricultural commodities. So we'll see where this goes. Right now, in my world, it's neutral trend. It was bullish, so it's kind of on a tight leash for me. We'll see if I stick with it. Here's another one that's just been amazing. INFL, which is an inflation beneficiaries ETF. We got long here back in the early December, added a position here, we had a full position on the 8th, and then it just took off at the last week. Sold some, sold some, sold some yesterday, and was again higher, just straight line up. So we got this inflation thing sort of bubbling beneath the surface and really starting to maybe impact consumer prices at some point in time. But this has been a powerful rally in commodities. And then I took out a position in XLE. It's the final one I'll talk about on this edge. Started on the 30th, added some here on the 5th, got my full position here on the 8th. I'm holding. This, if I go back to a weekly chart, you'll see that this is breaking out from a long base. Anything above 47 is basically good to hold. Add if you get pullbacks to that range. And then GDX. GDX has been a good trade. I sold some in this time frame. I actually got stopped here, first stop. It turned around the next day. So I took off 25% of the position, still running GDX on that account with a somewhat smaller position than what I had. SPY yesterday was an opportunity. I got stopped out here back in November and then rebuilt this position in December. Remember last time we talked, we were thinking Santa Claus rally might really happen for us. It didn't happen in SPY, but it did happen in a lot of other markets, EFA and EEM, for example. But I still like it. It's still in a good bull trend. Yesterday, we pulled back to the middle of the range. I bought some here, and I've got 100% of my SPY allocation on right now. So hopefully this thing runs. We've been long EFA here, got long on the 1st of December. It's just a runner. I haven't taken anything off on it. It's just steady, moving higher, moving higher. So that's developed markets. And then EEM actually had built a backup position here in the early December, stopped out, got stopped, took 2 days of position size off. And then it reversed and went higher, so I kept that portion of the position. And then when it blew out here on the 6th of January, it took a little bit off. So again, this international in U.S. dollar-based terms and emerging has performed well. And then the other one, VPL, which is a Vanguard fund. It's a Pacific Rim. It's overweight Nikkei. Or Japanese stocks, Korean stocks. I mean, Korea is basically 2 stocks. And this thing, I built a position again in mid-December, took some off in early January, took some off on the 12th of January. So really strong positions in international. I'm coming to the end of my sort of review here, but I just wanted to note that last week I had this buy TLT. I have a very small position. TLT's just chewed me up over time, so I'm not loving it. I have a bigger position in IEF, which has performed a lot better. But I did get a buy signal last week. I have a small position. I think Raphael may touch on this when we talk later. Final one. This is FBTC, which is a Bitcoin proxy. Got a signal last week. Took a very small position in my trading account. So I'm open on this position. It's about plus 10%, 8% actually, since when I got it on the 8th. And we'll see. This just ran. I got a really good entry here, and it just ran. Of course, it did pull back today. So let's just see if this pullback continues. I plan to add to this position because I do think we're going to get a Bitcoin run again. So that is it for me, gentlemen.
Thank you, Ted. Very interesting, as always. Yeah, I think that all 3 of us are relatively bullish on Bitcoin. At least this is my opinion for now. Let's hear it. So, Raphael, what are we buying Bitcoin and selling everything else, or no?
Yes. So yeah, I'm actually getting quite bullish on Bitcoin. So I added some, and I'm looking for more confirmation on the volatility side to add some more. Also, still very long gold. Started a small position in silver, thanks to you. last year at the middle of December, and surprisingly, I'm still not long ES. So I'm gonna show you a lot of bullish stuff about ES, but I'm not buying this one. I prefer to hide in the safety of precious metals and Bitcoin. Another thing I'm going to talk about is bonds, where I'm seeing some shift. So let's dig into this. Okay, give me a sec to organize. Okay, so as I said, um, everything is pointing to bullishness for ES, but I'm not taking the bait. So first of all, I'm going to address the bullishness of it. So, as you know, I monitor the volatility of ES constantly, and what it's doing now, it's actually quite good. Volatility is pointing down, trade of volatility is pointing down. This is quite bullish. The other way I measure volatility is on my matrix indicator, which follows Ray, and you can see the volatility is quite contained. This is quite good for an asset that is bullish. Another thing that happened recently on the VIX is up here on the matrix. I have a predefined level where matrix will go, where I actually look for dips in equities. So everything is pointing to that, especially looking at VIX here. My expectation is that VIX is actually going to go down. So everything is pointing to a continuation of the move up in ES. Yet, my main issue regarding ES is the fact that tech doesn't look as good. And what you want to see in a good bull market is tech leading. So I'm going to talk about specific stocks later in the video. But just looking at the volatility of NQ, you can see that it doesn't look the same. It's actually quite choppy. Short trade is pointing down, but the fact that the volatility is not contained and that it's been since mid-December at least that NQ is chopping. Some big tech stocks are actually quite bearish still. No change since the video we did a month ago. It's something that actually not makes me very bullish equities, despite everything I'm saying. So I've decided to focus my attention to other assets for now. So that's my take regarding ES. Surprisingly, and we were talking about that before the show, other countries are looking actually very bullish. I want to show you. So first, we're going to go to Europe. We're going to go to Germany. And okay, here. Look at the difference between Germany, for example, DAX volatility versus what you saw in NQ. Volatility is pointing down, trade of volatility is pointing down. Here on the matrix is the same. Look how contained it was. And this containment in volatility started around the middle of December. And since then, what you saw is a rip in the DAX. The same thing happened in the CAC. Here, look at the volatility on the matrix, look at the volatility profile. This is very bullish. FTSE exhibiting the same thing. Volatility on the matrix, volatility on my volatility signal, and the asset is ripping. Another ripper, Nikkei, same volatility down, volatility on the matrix also down. So, I mean, if you had money to bet in the past month, my recommendation would have been to actually go to those markets and not go to the US ones. Again, I'm not buying equities. I know VAI is quite long Nikkei, but I prefer to focus my attention on something else. Now I want to move on to DXY. And in the last show we did months ago, we had volatility of DXY actually rising. And I was mentioning at the time that we were approaching very important levels on DXY and that it had to hold, or we would definitely confirm the switch to bearish trend. Since then, it seems that DXY actually held its ground and started to move back up. Volatility is exhibiting a bullish pattern. So for the asset, you can see here volatility is going down. Here, the volatility on matrix is also contained, and it has tried to reclaim a bullish trend on MFR. So let's see what happens next week. But the clues that the dollar is giving are actually quite good. So let's see if we get confirmation. But my expectation would be that we transition back to bullish trend on the dollar. Now again, going back to VIX, I'm not seeing anything indicating a spike in VIX. VIX is below trade, it's below trend. Trade is below trend. So nothing is saying that you should expect a volatility spike, especially here when I zoom on the volatility profile of VIX. Volatility is rising, trade of volatility is rising. This is not something you see before a huge move up in volatility. So let's say you are still taking the bet of buying US markets. I mean, for now, I would say there is you should not be that worried. Only the fact that tech is underperforming maybe should concern you, maybe in the near future, maybe February, maybe beginning of March. We are not here to make predictions, but I would say this thing should stay on your mind. Apart from this, volatility of VIX is still rising. VIX should go down. So that's my take regarding VIX. Now, another one that I'm actually watching is CL. So I want to actually buy this thing. I'm looking for an entry. For now, I'm not getting it. Why am I interested by this one? So first of all, the volatility profile is starting to transition. So you can see here, volatility is going down. Trade of volatility crossed trend of volatility. So you can see it here on the chart. You can see it here on the volatility script. It tried to go bullish on MFR trend and rejected. We had a big down day today. But yeah, I'm watching. What is still keeping me out of it, and I'm watching this constantly currently, is here the volatility profile on a matrix indicator. What I want to see is something that actually looks like this. I'm going to show you when you get a rip and you'll see the difference. So this is what I want to see. Volatility contained. And what you get is a very big move up. I'm going to show you some other example here. Same. Volatility quite contained, and then you get to move up. I have another example I highlighted here, but you can see here. This is when you see CL actually rip. For now, you can see the difference. It's not there yet. I think we're going to get an entry. So I'm watching this one quite carefully. I thought we were having it 2 days ago, but it didn't happen. So yeah, this one could be a new position, maybe before the next show. But yeah, I'm monitoring that. If it doesn't happen, it doesn't happen. But the transition is happening. Now the gold. So the big question is how far is this thing going to go? Looking at the volatility profile, it looks great. I mean, both on metrics and also on my volatility signal. Trade is pointing down. Trade and trend just crossed. I mean, this is exactly what you want to see in a bullish asset. So for now, I see no reason to get out of this position. I think this thing is going to continue. I have some ideas about the targets. Actually, you can check on the MFR ones that are provided, and they are still quite far away. But yeah, this thing just keep holding. Now, the one that I'm quite interested right now is Bitcoin. So why am I interested in Bitcoin? So you remember we started a position around 83K. I tried to add in this area, but got stopped on the add. I didn't add on the retest here, but now I'm adding back. So the reason why I'm adding back is because on the matrix, the volatility profile is looking actually quite good. Volatility is contained. This is good. Here, what you had was the cross of volatility with trend, and volatility of Bitcoin is now at the floor. And you remember what I like to see on Bitcoin before we see the move to rip phase is volatility pushed down at the floor. So this is when you get the rip. My next ad that I will be watching is when trade actually cross trend. This is when I'm going to add some more. And I think this one is going to rip. It's going to rip quite hard. It already transitioned bullish on MFR. We are getting some confirmation also from Ethereum, but also from some other coins, some other stock related to crypto. So I was expecting the transition to bullish trend. We got it. I want to see trade and trend cross to add some more. So I'm quite bullish crypto. Now, one thing that I think is of interest is yields and bonds. So we got the transition here for volatility. So volatility of US 10-year to bearish, meaning the asset was bullish. But what happened, and it was surprising, I have addressed this for the past two shows, was the fact that the US 10-year, but you had the same on the US 30 years, were unable to rip. You had a gentle bullish trend, but nothing fancy. And now we are at the end of the road because trade of volatility actually reached my minimum daily trade. Minimum daily trade is based on the volatility profile of US 10-year, is when you actually expect volatility of the asset, so in that case, US 10-year, to start to go up. What happens when the volatility of US 10-year start to go up? Well, the US 10-year will go down. US 30-year is exhibiting the same kind of pattern. And when you look at bonds here, they are starting to try to reclaim trade. So I'm going to show you TLT. TLT is about to cross trade. Volatility of TLT on the matrix is also exhibiting a bullish transition. EDV looks the same. So my expectation, maybe it's a bit early, but my expectation would be that we should see a transition of bonds to bullish and transition of yields to bearish. This is something you should start to monitor right now because I think this is probably something that will define 2026. Now, let's go to the tech mess. So I have highlighted some names. I want to focus on NVIDIA, Microsoft, Meta, and I'm going to talk about another big name, which is Apple. So the picture from last year with volatility rising on NVIDIA is still not over. So volatility here is quite elevated. You don't get a bullish trend transition with volatility that high. Now we are at a place where maybe we could transition on NVDA. But if you are taking a position here with high conviction, in my opinion, you're crazy, you're nuts. So NVDA, the darling of the past few years, is not looking great. And look at Microsoft as well. Look at the volatility. I highlighted that since what, October to December, and it's still rising. The volatility of Microsoft is still rising. And of course, what you get is a crashing asset. Meta looks the same. Volatility is still rising. Seems to be no end in sight for big tech names to find the bottom. So when you see that, despite the fact that ES looks good, I don't expect a big jump in VIX right now. I don't feel confident to go long US equities right now. And another one I wanted to show also is Apple. So Apple looks horrendous as well. Look at the volatility, just rising. So when you see that and you see that people are talking about we are back to a crazy bull run, etc. But tech is underperforming, and you have big names like these that are still bearish trend, and for now, at least, no end in sight. I would rather focus my attention and capital to some things that are actually working, which are precious metals, crypto, and most probably bonds, and maybe oil. But oil is a big conditional. Okay, so that would be my take, and this is what I'm going to focus on.
Thank you, Raphael. Great. Yeah, the only tech stock that I like for the last 6 months or so is Google. Basically, it's very hard to see any positive scenarios for these big tech names. Yeah, and it's quite a concern. Okay, I will share my screen. Which one it is? Yes, this one. And yeah, we will talk about. I need to get rid of this. Yeah, and we will talk about the usual suspects first, and then we will talk about some numbers and the overall view in the markets. A lot of things are starting playing out. It took a while, especially for bonds. We will see if this move will finally start, but at least we can see some positive signs in these markets that maybe moving bonds is about to begin. I was bullish bonds for at least a couple of months, but it was very hard for bonds to break out of this range and to settle above any of our major macro levels or flattened zones. So first about correlation. So we are in negative stock dollar correlation regime, and this recent strength in dollar is causing some troubles for US equity markets. And we will continue to see that for a while, especially if US dollar will continue to appreciate in value. But yeah, so if we are looking at 21-day correlation matrix, we see SPY UUP at negative 0.22, and stock bond correlation is actually positive. But what I wanted to talk about and to focus today is the average correlation. We are again in a very low average sector correlation regime. It's a rotational signal for stock pickers, and the capital is moving out of one sector in particular, which is of course tech. And this recent moves in oil and precious metals, of course, are helping our sectors as well. So this is exactly what we are seeing in the average correlation. So usually this is a bullish sign for overall market, but because of these big weightings of these big mega cap stocks in the S&P and the Nasdaq, this time it can lead to a sell-off in equities. At least for now, we don't see any sell-off. Market is struggling. ES is literally stuck at that 69.83 level we were talking about since September. I'm overall bearish in stocks, but basically this move to either direction now can continue and can continue to for a long time and be quite brutal, depending on your positioning, of course, just because of this average sector correlation, which is at 0.36 if we are looking at a 21-day period, which is relatively low. And if we go to 10 days, you will see that we have a same situation, which is at 0.3. We are in a relatively low correlation regime. Of course, the shorter the period, the faster it can change and the choppier it is. But overall, we see these capital flows, and especially out of tech, and this is what is causing that. Well, not only that, of course, we see a lot of movements in other sectors as well. But basically, this is something I wanted to talk about. And if we change correlation period here to 10 days, which is the second period based on importance, we see something different here. Well, not really, but we are in a actually positive correlation or no correlation at all. Let's call it with stocks and dollars by UUP. 0.11 is very weak correlation, but still relatively positive. We are in a negative also almost uncorrelated regime when it comes to stocks versus bonds. So if we use the shorter periods to try to time and predict the changes in overall regimes and in the longer term moves, this is something we need to focus on and care about. So we will see how it plays out. Now it's very hard to use either bonds or dollar to trade equities, just because these correlations are pretty weak. But yeah, we are seeing the switch. We are seeing the switch, and also we are already seeing some moves in equity markets. So when we switch to ES, yeah, so we have this sticky level of 69.83, which we just can't win against. Of course, we had multiple tries, and the market is grinding and making new all-time highs, but market is really struggling because capital flows are not one-sided and are not in favor of overall indices. Same applies for ES and NQ. I really like the take that Raphael said that on during strong markets, strong bull runs, you want to see Nasdaq outperforming. And if we are using our matchups, if you look at your macro zone spreadsheet, or if you just write down the levels I was talking about since September, we know that 69.83 in ES is equal to 25.907 in NQ. And already since November, NQ is way weaker than yes, it started quite strong after September expiration, but after that it only lasted for a month or so, and NQ is weaker since then. So if we go to our watch list, you will see that ES settled at 69.81, which is basically that level, but NQ is 200 points below 25.907. And also yesterday we had this very important fight in NQ. ES not so much, but if you use our yearly pivots, which is for now will be the most important price for us for the entire 2026, which is 25,478. Yesterday it looks that there is a possibility that we will close below that. It was not the case for ES. ES level was 69.02. But NQ traded below that level, but bulls won. So we had this pretty important fight yesterday, and at least for now we are saved, and the market bounced a little. Of course, today we had quite a choppy day. At first, it looked that maybe we will get some. Strong bullish day, but actually market closed only a little green. So we will see how it works. But pay attention to yearly pivots. Now this is the most important number, and our flattened zones. But flattened zones are below, lower. In ES, we are focusing on 67. Sorry. 95, and in NQ we are focusing on 25,100. Yes, 25,132. So these will be the levels that will change the entire trade, that will change the capital flows. And if we really settle below these levels, we will see sell-off. I'm pretty bearish, as I mentioned in the middle of December, that I expect tough 2026. Of course, we don't know if we get some sell-off like in 2025, which, in April everything looked really bad, but we closed the year strongly and bounced very quickly. So either we will see the same situation, or we will see a tough and red year. But for me, it's very hard to not expect some correction and increase in volatility. For now, Raphael is absolutely right. We don't see any warning signs when it comes to volatility, but this is something that I expect. And if you watched trading plan video for January, we were also talking about a level for the entire cycle, which is 7,500. I showed you how to get that level, but basically if we get some move, we still have targets at 73 handle and 75 handle, and MFR annual targets show that possible upside is all the way to 8,000. But of course we have downside targets as well, and they are pretty low. So for now, I wanted to spend some time talking about this, because it's the beginning of the year, and we finally have 2 weeks into the new trading year. So now we can already start leaning towards our yearly pivot and yearly opening price, because as I mentioned in a trading plan video, of course, it's hard to focus on yearly open on the first day of the year, because obviously we are trading either at that level or very close to it. But now when we have 2 weeks in already, these are the numbers that I will be using for the entire year to basically position myself in any markets at all. So we had a great cycle in oil. One thing that I disagree with when it comes to volatility and trading is that for now, I see no reason to be waiting for something when it comes to oil. We had a very, very strong cycle. We had a flattened zone at 56, 66. And we had targets all the way when it comes to oil. We had targets all the way to 62 handle, and this was basically a very easy trade. When it closed up above 56, 66, all you have to do is to basically be long oil and scale out at macro levels. I really like oil, but I never trade oil for longer periods. I mean, months or so. Usually it's swing trades that last only for a couple of days, unless I catch something and can have my stops in break even on or in profit, and then just leave it. But I just know that oil, sometimes it looks like we may be in the beginning of some trend move or change in a regime, some important shift, but actually all we get is 2 days or a couple of days of movement. But yeah, this month for oil was great. Before the show, I was thinking whether I need to spend some time talking about silver or not. And most likely I will not talk about silver. I will only say that For now, the only thing we can do with silver is to scale out at our zones, and currently silver is trading at $9 increments, basically $9 increments. So we have macro zones at 79 and 88 and change, and the next one is 97. So all we can do is basically use these levels to trade. But I'm really, for 2026, I'm really bullish on platinum and copper. I tweeted that. I think that long platinum, short gold is a trade. Um, of course, I'm not expecting gold to go down in value, but I like to think in pairs when it comes to these trades, because it's easier, especially in this volatility, to play for relative outperformance instead of direction. Either metals will go up or down. I expect platinum to outperform gold in 2026. So this is my main focus. And when I'm looking at platinum gold spread, I'm actually looking for decent spots at spread targets where I would initiate that trade. But for now, this is the most attractive idea that I have for this beginning of 2026 period. Yeah, so of course, CME margin increases will not change anything. This move, at least for now, is not driven by retail investors. Actually, retail participation in this is low, and if we get this continuation and silver continues ripping, sooner or later we will see retail flows. We will see retail also noticing the silver market, maybe via SLV ETF flows, or of course CME will have smaller sized futures. How unexpected it is. Yeah, but for now, a lot of people on Twitter are saying, oh, it's hard to buy silver. Um, Hard to buy silver, almost impossible, and so on. Well, if you see comics, vault stocks when it comes to silver, even though CME Group is not known for being physical exchange, most of the volumes are actually paper, so it means no one takes delivery, but you can get that delivery. So if someone says that it's impossible to buy silver, well, buy futures contracts and hold till expiration. Well, there are no issues like that. We see a China squeeze, and now the only question is how long it will last. But yeah, don't ignore copper, don't ignore platinum. I don't like palladium, especially because it's very hard to trade it. There is absolutely no liquidity, and that's why we get these erratic moves. But I think that Dr. Copper is finally at a stage where it will catch up to its peers, and also I'm really bullish on platinum. When it comes to equities and currencies, I'm actually looking at Japanese yen, and this is one of the reasons why I still think that we have some juice in Nikkei, and I'm quite bullish Nikkei. The only thing in equity markets that for me is hard to justify, and that's why I'm not trading it, is of course the strength in European equities. But watch USD JPY. USD JPY, at least for now, it looks like that it can go to even 169, close to 170 handle, which would be my final target. Final target would be, it means that if we ever see this number in USD JPY, I will buy yen for sure. So if we go to, yeah, FX yen is decent. So let's say 10 full points, which also would correspond with our annual target, but it's not the reason why I wanted to buy that. But yeah, I think that Nikkei still has some steam and can go up unless we will see a reversal in Japanese yen. But for now, when it comes to flows and yen and overall action in the USD, I'm mostly bullish on Japanese market when it comes to indices. Yeah, so long story short, I wanted to use this first market talk to talk mostly about the expectations for the year 2026. No particular trades. I will not talk about individual stocks because Raphael did a great job, and basically the only thing I added is, of course, that Google is still looking strong, and also we have very amazing signals in defense sector. Things like Lockheed Martin is on fire. Rheinmetall here in Europe is on fire. But yeah, my biggest concern when it comes to U.S. Equities is this rotation out of tech and possible changes in the USD direction. So possible changes in the dollar itself when it comes to FX markets. Yeah, so I talked about bonds, and I talked about bonds for maybe last four market talks, if not more. But I know actually I think that the hidden bull market will be in bonds and things like that, and it was very hard because we have our flattened zones, we had macro zones, and bonds were just not breaking out. Bonds were literally trading below all the important levels, and for now at least we see signs that the ZB and ZN is finally showing strength. So you know that I use the futures markets for all my signals, but then you can trade anything you want. So of course IEF, TLT, and other stuff. But this is the main thing to watch, and also Raphael mentioned that already. So I absolutely agree that now you should be watching bonds, and I absolutely agree that U.S. equity market is not the best looking place right now. Of course, you need to have some exposure on that, but I would reduce. And if we get a grind higher, so continuation in this Q1, great. At least you will have some exposure, but I would not be increasing any my sizes, especially in tech related names or indices or sectors. So of course we have Nasdaq and SPY. Russell, Russell, of course, is behaving a bit differently, but I use Russell more of a indicator for a regime. So these ratios, SPY or QQQ against the Russell, and the overall performance of that. So risk on and risk off. So of course, when it comes to Russell, we see that for now the regime is risk on, but we will see how long it lasts. And just because of this rotation, it's we're still seeing issues when it comes to bigger cap stocks and indices. So of course, yes, thank you. So this is that, and yeah. So look at a yearly pivot for Bitcoin. You will be happy if you do. And we have targets when it comes for Bitcoin. I can tell you a couple, but we are already seeing some signs. So when it comes to Bitcoin, basically we had a flattened zone of at 87,000 when it comes to CME futures. Of course, we are way higher than that. And for targets, we are basically here, important level at 98,000, and then we can go all the way to 110. So scale some out at targets, but Bitcoin now is bullish. It's definitely bullish, and yeah, so most bullish things for me are bonds. The bonds, of course, it's a question because we need to see if this move actually has some legs in it. But yeah, Bitcoin, Japan, and yeah, momentum names. By momentum names, I mean the ones that are actually moving now, not the ones that are usually moving. So things like defense and crypto related names are good examples. But yeah, this is my view. Be careful, be aware that at least when it comes to my process, I see 2026 as a year where we will have some hurricanes and volatility in markets. So we will see how it goes. But this is what I expect, and I'm very cautious. But again, market is always right. If market is not falling, please don't initiate any short positions when market is making new all-time highs. Yeah, so that's it from me.
Thank you, Vai. Looking at the questions, I think we addressed all of them. Bitcoin, platinum, silver, and yes, some oil.
Yeah. I just wanted to add that at this period of increased volatility, when we have these insane moves, especially in precious markets, best thing to use is actually targets, because uh, top of the range, especially top of the regular range, will be hit almost daily. So it's better to lean on longer term targets and macro zones for risk managing these positions, because range is of course risk profile and it's a timing tool, but basically with this volatility, what you will see, that range says that tomorrow's top of the range is there, and of course silver will go there. So that's basically it. So.
Okay, very good. I think we can end here. And let's see, maybe in 2 weeks there will be some shifts in some specific asset we talked about.
Looks like, and at least for now, I don't expect any crazy moves in indices, but maybe it would make our job more interesting, because the least interesting thing is when equities are just grinding slowly higher, or are stuck at these levels for weeks like we are now. So we need some volatility, and I hope we will get it either way. Yeah, so thanks everyone. I hope it was useful. Thanks, Raphael. Thanks, Ted. I wish you everyone happy 2026, all the best, and of course, profitable and healthy year to our viewers and subscribers as well. Yeah, so manage risk. Thanks, everyone, and hopefully see you in 2 weeks. Bye.
See you in 2 weeks.
Cheers.
Bye bye. Putain, Sophie, je t'en direct là, tu fais un max de bruit quoi. Yeah, my wife just arrived.